Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurat. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
The universe may not have a plan, but it clearly enjoys irony. We taught machines to think. They taught us to doubt our passwords. The difference between art and nonsense is the price tag. Online debates are where nuance goes to die. Breaking news is often just yesterday's speculation with better lighting.
India's FX reserves just hit a record $703 billion. Okay, it's not actually a record, but considering the fact that quite a bit of reserves were burned in defending the rupee, this is not a bad number. But the real story here isn't the dollars, it's the gold. RBI's gold stash has now crossed $100 billion, the highest share of reserves in almost 30 years. The share of gold in total reserves has shot up from barely 1 to 2% in the 2000s to nearly 15% now. That's not diversification, that's quite a statement. As Warren Buffett once joked about gold, it doesn't do anything but look at you. But well, given these numbers, it's looking pretty good. So who really owns India's mutual funds? If you thought it was retail investors with their SIP screenshots, think again. The biggest chunk, a solid 37%, comes from corporates. Yes, companies are the real whales in the MF ocean. Next up, high net worth individuals, HNIs, are at 34%. And these are people who say, I only invest when there's blood on the streets and somehow always find the dip. Retail investors, we are at 27%, respectable, growing fast, but still not running the show. So China is making another push to turn the yuan into a global funding currency. Because if you can't beat the dollar, at least try to undercut its interest rate. And right now, borrowing in yuan is very cheap. The yield gap between China's 10-year bonds and US treasuries has blown wide open. Translation, if the dollar is a premium credit card, the yuan is the no annual fee option trying to win customers. Beijing is pumping the system with panda bonds, dim sum bonds, offshore yuan loans, and is working a little. Overseas borrowers raised 1.4 trillion yuan last year, and offshore yuan loans hit 2 trillion, up 14%. Here's Lawrence McDonald's favorite chart, India INDA versus China FXI, and it basically looks like a decade-long boxing match where India keeps landing the late round punches. From 2016 to 2021, the spread climbed steadily as India outperformed. Then it went parabolic in 2022-23 when China imploded under tech crackdowns, property meltdowns, and whatever new rule Beijing wrote at 3 a.m. But now, after a big correction, the spread is sitting around 1.33, and this is where the bulls say, take down China, go long India. If you have ever wondered what money looks like when it stops being shy and starts showing off, well, meet Liechtenstein. Sitting at a jaw-dropping $232,000 GDP per capita. That's not an economy, that's a flex. And yes, it took me quite a bit of time to learn to pronounce that name. Right behind it, Luxembourg, a place where banks go for spa retreats, at $147,000. Then comes Ireland at $109,000, powered by the world's most enthusiastic tax planning multinationals. If corporate headquarters were Pokemon, Ireland has caught them all. Switzerland is at $111,000 because being neutral apparently pays extremely well. Iceland follows with $98,000, proving that a country can have more volcanoes than people and still outrank the US. Welcome to the July 2025 Internet Leaderboard. At number 1, with a ridiculous 16.2 billion visits, it's Google. That's not a website, that's a front door of the Internet. It drives 63% of all web traffic to US sites at least, which means Google isn't just the referee, it owns a stadium. At number 2, YouTube with 5.7 billion visits. Facebook lands at number 3 with 2.6 billion visits. Amazon is at number 4 at 2.5 billion because capitalism also needs a homepage. Reddit at number 5 with 2 billion visits, a place where experts and absolute chaos coexist beautifully. India is quietly building two monsters, and no, they are not unicorn startups. First up, surveillance. The CCTV market is jumping from $4.8 billion in 2025 to $12.25 billion by 2030, at least that's the estimate. That's a 20.6% CAGR, which in market speak basically means we're installing cameras faster than people can notice them. Now the second monster, data centers. India's data center market goes from $10.1 billion to $21.8 billion by 2030, growing at 16.6% CAGR. That's again an estimate. Because once you collect all that surveillance footage, e-commerce logs, UPI data, reels, memes, and existential WhatsApp forwards, you need somewhere to store it all. Even IT load capacity is tripling from 4.48 thousand megawatts to 12.47 thousand megawatts. India is buzzing. Young talent, world-class startups, unicorn factories everywhere. But then you step outside and the infrastructure politely reminds you that potential alone doesn't build highways. This chart says it all. From 2 trillion rupees in 2014-15 to a massive 11.2 trillion rupees budgeted for 2025-26, infra spending has grown more than 5x in a decade. These bars look impressive, like India is building a new country every budget season. But here's the catch. India isn't competing with its past. It's competing with China's roads, Vietnam's ports, and Indonesia's industrial parks. And compared to what the economy needs, this spending is basically the appetizer and not the main course.